Welcome to this video. We're going to talk a little bit about the difference between accounting profits and economic profits. At the end of our video on the basics of supply and demand, I've got the diagram and I've left it here, which shows that in perfect competition, a firm will essentially face a demand curve that to its perspective is a horizontal line. It can sell whatever quantity it wants at that price. It can't get a higher price. No need to take a lower price because it can sell whatever quantity it wants at the going market price. And in equilibrium, as we drew it, and just a quick refresher, we've got the amount that they're going to produce is going to be where the marginal cost curve is crossing the demand curve. Let me just mark that for you so it's going to be easily seen. So it's at this point right here. This is the quantity that the firm will produce, and it'll be at the going market price. Now, given that that's the equilibrium position, and in this case you can see that that's where the price exactly equals the average cost curve, and therefore your price equals your average cost, that leaves zero economic profit. Now that's what I really wanted to focus on a little bit in this presentation here, and that is how economists describe economic profit and the relationship to accounting profit. So let's start off from the economist view. Bring this up here. And from the economist view, they're going to say, well, the way they think of the world, we're going to start off with revenues, which is simply equal to the price that you're selling times the quantity, or P times Q. And we're going to subtract from that all the costs that we're incurring, the labor costs, that we're paying the workers, the rent we might pay for land or buildings, etc., the utility bills. We're also going to subtract off, when economists think about the problem, we're going to subtract off the opportunity costs. And that's essentially to say, if I'm going to be investing my money in this business, I'm foregoing the opportunity to invest it in other businesses, and I need to make a return for that. And when I have that view of the world, and I've reflected my costs, my opportunity costs, etc., just give ourselves the bottom line here. At the end of the day, this is just going to be a zero. So what we have is essentially a situation where an economist's view of this equilibrium is that there's zero economic profits. That's not the same view as what would happen for a accountant's view of this world. So I'm going to separate this here and say, how would an accountant think of this differently? An accountant will tend to start off with revenues, and then they will subtract from revenues the costs and they will then conclude that there is an accounting profit. And that's the critical difference between the nomenclature of the two different disciplines. Economists will reflect the opportunity costs and say that in equilibrium there'd be no profits. And an accountant would say, well, no one would make no profits in equilibrium, but that's because they're referring to accounting profits, and accounting profits do not reflect that opportunity cost in the measured profit and loss statement. Now, to keep going with this theme, in transfer pricing, we're always going to be looking at accounting numbers because we can't actually observe the numbers that would be happening from an economics point of view. We're going to be looking at our tested party, which is going to give us financial statements, and we're going to be looking at comparable firms often, and there we're going to be observing their accounting statements. And we're going to have to make some sort of conclusion as to whether our tested parties are using prices that are arm's length. Much of this has been covered in earlier videos in the background, based upon how their profits look relative to those of other firms. And we are often looking for what we say would be the simpler tested party. We want to test the P&L of the party whose profits are going to be the most reliable to analyze, meaning they're relatively simple. And one of the issues that we talked about was that the impact of swings in profitability and what that's going to do to your analysis. So if we take this example and let's say we continue, remember in our earlier example, we talked about the concept of a shock to the demand curve. And from the perspective of, I'm going to make this brush a little bit bigger. From the perspective of the, make that D prime for a new demand curve. From that firm that's out there competing, if that's the new demand curve, this offers new opportunity. You can see that the new price is going to be higher. Let's put it in a different color so we can sort of observe it better. Make that star. And we're going to sell a little bit greater quantity if we go down here. And our revenue number, which is this price times this quantity, is going to be this area, this rectangle, and it's gotten larger than what we had before. So when we have a positive economic shock that pushes demand out, so we'll say, what are we going to notice here? When we have a demand shock, well, one of the things that's going to happen is we're going to get, if the shock is positive, so it's pushed our price is higher, quantity is higher, revenues are going to be greater. Our average cost is probably slightly higher. And we're going to notice that now, because of that, we're earning an economic profit. So with that economic profit, what we're going to see is essentially a higher return. In this case, when we're looking at financials of various firms, we're going to be seeing a bounce up in their profitability. We could have had the opposite case. We could have talked about a demand shock that actually was a negative, that it was contraction in demand that brought the price down, actually to a price that would be below your average costs. And in that case, a firm may be losing money, at least temporarily. Now remember, we've talked about these as being a temporary sort of situation because if the firm were earning economic profits, it would be expected other firms would enter into that industry, increasing supply, pushing price down, and bringing things back to an equilibrium where all the firms are operating where they have no economic profits, they would have normal accounting profits. And we sort of think of that as sort of the normal kind of thing that we expect. But because of that up and down shocks, that tells us an awful lot about when we're looking for comparables in transfer pricing. One, we need comparables who are affected by the same economic factors, so they'll be moving together with our tested party. But also, it's one of the reasons for why we use multiple year averaging, which is to say any one year might have a demand shock up, a demand shock down. We could also talk about supply shocks that might be pushing the profits away from the longer term equilibrium. But in the long run, it's coming back to that. And hopefully by using multiple years that we help smooth a great deal of that out. Thank you and have a great day.